Jeremy Robb, interim chief economist at Cox Automotive. Welcome to the show.
Thanks for having me
Jeremy.
here. Good to see you guys.
Thanks for being on the show, and thanks for responding to our request to come on and just tell us a little bit about how were things in November. So, from your perspective, how was automotive sales in November?
Yeah, we don't have all the data yet on that, but we watch it every week, really every Monday morning. We're pulling that together, looking at what's been happening in the industry, and we've seen better trends through most of November than we had in October. I think across the industry, we look in the wholesale side, the retail side, anything that we saw, a lot of our economic data, we saw, things slow down right at the end of September, and October maybe be a little bit softer, and then we started to rise and move a little bit better in terms of sales and positioning like that in November so far. So we've seen trends be better in November. They're nothing to write home about. I wouldn't call it that, but up from where we were in October, both on the new car side and on the used car side. That's kept day supply, at pretty decent levels, not rising too much right now. And that just goes into, there's a lot going on with the consumer right now. And especially in this period where we're just starting to get some of that data from the government to come back after the government shutdown, that there's a lot of things that need to be interpreted and looked through. And I think over the next few weeks, we'll get a little bit of a clearer picture on some of that.
So to your point, give us a little peek at that. Dealers keep hearing about this consumer slowdown, right? But your data shows something different. What is the media getting wrong about the current market in automotive?
Yeah, so the narrative, the broad narrative, I think you guys know this and most people do, is affordability has been a huge issue, and it remains a big issue. Every day you see an article or a news post or something on TV about affordability that may have to do with housing. It may have to do with the automotive market. It's probably has to do with food. We just had Thanksgiving. Everybody's very, very aware of what the prices of things are, and then we're coming off of that right when we had this government shutdown last for the longest period ever. And that affects a lot of people across the United States, holds back spending, slows things down, really can put a dour mood on the surface of the consumer. And we saw that if you follow the University of Michigan consumer sentiment data, it's basically sitting at an all-time low, but we follow other things like there's some daily indicators of consumer sentiment that show that it's starting to get a little bit better. And so I think that's part of the narrative when you're dealing with data, trying to see the big picture of what happens. It takes time for that to play out. And we don't have a lot of the data.
Speaking of that data, though, you have data on inflation's impact on auto sales. What data do you have on that?
We do. So this is something I put together in the last 6 weeks or so. And I present a lot to people. And this is a funny thing about this chart. When you talk to people a lot, you start to feel like what is resonating with them. And it usually takes me 5 or 6 minutes to get off this slide alone because people start asking you questions about what's happening. So what this does, it's measuring different parts of inflation in sectors, and specifically in sectors that can be tied to the automotive market overall. And so I got all this data. It's all publicly available information. But what I did is index all of it to January of 2018, where it all equals 100 then. That gives us about a 2-year run rate prior to the pandemic hitting. We know inflation took off then, and then you can see what happened. So if you look, the black line, that's your consumer price inflation index. It's averaged up 5% every year for the past 5 years. So even though we've seen it slow down, it's still in consumers' minds, it's been very, very strong.
Significant. Yeah.
Definitely significant. And then you look at kind of the blue line there, that's parts and equipment. That is more of like your DIY consumer. If they're going to get an air filter, something like that at a store, they're not experiencing costs that are quite as crazy because a lot of the costs that really impact your automotive sector are tied into servicing and workers and things like that. And that's when you look at that's the orange line there, the maintenance and repair cost. You can see how high that line has gone. And especially over the past 6 months or so, it's gone a lot higher. It's averaging up 8.7% every year for the last
Wow.
5 years.
5 years.
So really, really high. We know about sensors, EVs. In insurance. Insurance is the next one there.
That's a s
Severity when things.
insurance is astounding. Are we
Yeah.
reading that right? 13% increase every year for 5 years?
Yeah, you're reading it right. Now, one of the things that makes it so strong, but also so acutely felt by consumers, is if you kind of look backwards in that line and you see that when the pandemic hit,
It dropped.
insurance actually went a little bit lower. Like
Mhm.
people,
Yeah.
they weren't driving as much, right? And insurance companies offered them a break. And then starting in 2022, when the impact of inflation really got going, new vehicle prices were much higher, used vehicle prices were higher. They had to keep, you know, ratcheting up the cost of insurance. Not only did it start to eclipse the consumer price index, you can see that about the beginning of 2023, and then it moved much more, you know, up and to the right, any other sector there.
So, Jeremy, as a dealer and as a general manager watching the show, what's my takeaway for December and Q1 2026 with this inflation data? Where's the opportunity? How do I use this to gain an advantage in automotive?
Well, I mean, a lot of the things we've talked about all year long, and I think a lot of people see there's a trade down effect going on. Things are really expensive. Consumers are looking for anything that's more affordable. Starting to get a little bit better interest rates out there, so that should
Mhm.
be good. So you might see consumers trade down from new to used, maybe by brand, something like that. But then one of the things that's really going to occur, we've talked about some of this before also, is these changes in the tax code for next year are set to be pretty impactful. We estimate we'll see the average consumer will basically see the strongest tax refund they've ever seen next year, and
Hmm.
that could go up to about $3,700. That's a pretty good increase from people that were getting refunds last year, which was just over $3,000. So pretty strong there. And then what also happens starting in January 1, the withholding rates on people's paychecks are going to come down because they haven't been
Mm.
adjusted yet. So
Hmm.
consumers should start to get better take home pay starting early in January. And then they should get these higher tax refunds too, which, we know the spring market bounces there. A lot of people use those tax refunds as down payment to come out and buy cars. And, you would expect that unless there's something else precluding them from doing that, that they would do that, and those metrics would look to be pretty strong.
Jeremy, your tax argument is fascinating. I first heard that from Jonathan Smoke several weeks ago. Why is no one talking about this double benefit to consumers in tax season, Q1 2026, and the potential impact it'll have on automotive?
Yeah, I don't know. We shared it the first time in early October as part of the Q3 movie call, or the Q4 call we do publicly.
Yep.
A lot of the Wall Street banks have put out research that says yes, they expect tax refund season to be pretty good. Um, there's you know there's a lot of media that are really caught up on things that are negative. And it's really easy.
Yeah.
It's really easy to be negative
Yeah.
when you
Yeah.
look at the data and look at consumer sentiment and where spending patterns are going. And I we do use AI in a lot of things. Sometimes I run AI like to shoot out something for me, and it gets real negative really quick. And you're just like, whoa, man! Like this is I can't share this with people.
Yeah.
So it's like you've got to not only look at the rear view mirror, but also have a little bit of a view towards the future. And we've sat through several years of uncertainty, worrying about what the economy is going to be. And I think that's just led us to where we are today. All we can do is really try to have the best, most up to date information and outlook out there and provide it to everybody to use to make the best decisions with.
So before I ask you for the takeaway for a dealer preparing for Q1 and even to close out December, talk to us a little bit about interest rates. This is the gift that just hasn't fully delivered itself. We've seen the Fed rate reduced multiple times this year, but auto rates really haven't come down yet. Why
Mhm.
is that? And when can
Mm.
we expect the auto rates to come down? And will there be a positive consumer impact to lowering rates once that happens?
Yeah, I mean, to answer the very last question first, there's a positive impact for lowering rates. It it matters at the margin. It's not a huge incremental pickup for a consumer. I think it matters almost as much psychologically as it does on
It's
paper.
feel good.
Yeah.
Yeah, I
Makes it
agree.
feel
Yeah.
good.
Yeah.
Yeah, for them. If you get a point lower or something, then that can matter a little bit to a consumer. But if you look at it by credit tier, you do see that rates have come down, especially in the top tiers. 60, 80 basis points, something like that, starting to move the needle a little bit. But then what's also happened too is if you think about consumers, you think about student loan repayments. We've had more people move from, being higher in their credit score to lower in their credit score. So maybe they're not prime or they're not super prime anymore. They're like near prime or even back to subprime. And you start to see that shift of
Yeah.
having a lower credit customer in there. You look at the overall interest rate, it keeps the rate from moving down quite as much. So that's part of the mechanics of just some shifts in. You think about where the consumer and their credit tier bands are sitting right now when they come to make those loans. And then the other thing, obviously, in late Q3, we had some industry bankruptcies going on, and just some credit and lenders being hit.
Yeah.
And I think those definitely take those into account on the lending side and on the underwriting side when they're moving forward. And so even if they start to get a little bit of a reduction in their own buy rates, what they're able to buy at, they're not passing that along quite as much
So
as you think.
So following that, is there trouble in the subprime credit markets right now? We've seen some, some failures of Tricolor, some other lenders that have either said, "Hey, I'm out for whatever reason." Larry Miller's lending arm in Utah that sold the auto group to who was it? Anyway, they sold the auto group off, but they kept the lending arm.
Hmm.
The lending arm recently announced last week they're going to stop taking new applications.
Hmm.
Do you have concerns with the credit market now, or does it remain strong?
I think they pulled back a little bit. I don't know that I have concerns, but I do worry, and I worry for that lower tier consumer.
Yeah.
I mean, how does that person, that group of people, where do they get where can they borrow money, right? Or even if they can they make that payment every month on a 17 or 18% loan?
Yeah, because
So
affordability is so crazy right now. Yeah.
yeah.
Crazy.
So it is a multifaceted problem. The
Yeah.
credit is one aspect of it.
But you're
Yeah.
you're seeing that, I mean, people are prioritizing their auto loan payment, which I mean is a positive thing, right? For
Mhm.
us in the automotive biz. But to your point, so many of these things stacked on top of each other have led to this unaffordability that we're
Mhm.
dealing with right now. So there's not one thing that's going to bring those prices
Mhm.
way down. I mean, you're just stacking, 2%, 5% on top of each other, and we are where we are.
So,
Yeah.
so Jeremy, it's interesting on Facebook. I saw a recent debate among a dealer. Brian Benstock was in on it, and it was "Woe is me." The used car market is falling. Like used car
Mm.
pricing and valuations are dropping. Is that true? And if it's not, why does everybody keep projecting that and it doesn't happen, Jeremy?
Yeah. So I think some of that is context. I see people talk about that and reports on it. The worst month of the year for prices and for vehicles, especially wholesale prices for sure, is the end
Mhm.
of end of September into October. Okay. Every year, like if you're in the industry, especially if you're in the wholesale market, you should expect that prices are going lower over
Yeah.
that time period, and they typically do. And they depreciated a little bit more than they usually do this year, so got a little bit worse than what we normally do. We're expecting that. We're like we would be expecting that, and then you start to see retail prices come down a little bit after that. I tracked a top 50 basket of the top 50 3-year olds sold retail every week this year and last year, and that basket is holding right at 3.5% higher than last year on a weighted basis. So it's come down. It's come down. It came down for 7 weeks in a row until last week, and it was flat last week. But it's still well above where it is this year, and a lot of that's due to tariffs and inflation and pushing things up, and where the total market sits, and all. So I see those reports. Sometimes I shake my head. I try not to say anything about it. Our data says that we have seen prices come in down a little bit, but nothing out of what we would usually have expected anyway. And now, if anything, you're moving to a part of the year on the new car side. You start to see prices move up because you get a little bit of a better luxury mix into the marketplace. And then every week you see more of these model year 26s come in with a little bit higher price point too.
Okay, so take us to December and then Q1 2026. If I'm I'm a dealer, I'm a general manager at a store and I want to win. Thinking about the tax benefit you're talking about, the decreasing interest rates that are potentially going to fully realize over the next 2-3 months, the used car marketplace, how do I win over the next 30, 60 and 90 days?
Yeah. So, I mean, I do think that tax refund season will drive more consumers into transacting, pulling the trigger. And when you couple the tax refunds with getting, more take home pay in January, that could be a little bit better. We start to, every month we go through, we can push maybe a little bit of the tariff impact away from what's happening out there. I think that's good. If you're a new car dealer, um, and that is where you make a lot of your money, I do think you might be worried a little bit because we've shown that the new car world is like, it's very K-shaped, right? And it's much more tied to your higher end consumer. And there's been some volatility in the stock market and the Bitcoin market, things like that, that could come into play at your end. But we've got the Fed moving generally in the right direction for interest rates. The stuff with taxes and consumer incomes, that story, whether we're getting it out here today and everyone's going to latch onto it, or it's going to take another 4 weeks for everybody to, I do think that's going to matter a lot. And there's a lot of players, historically speaking, in the dealer world that have started. They start sometimes in December, trying to pick up a little bit more vehicles at a lower price, right, before we get into the spring market, even though knowing they're going to hold them for a little bit longer, right? But to have them ready to sell, and I think, I I don't think it's going to be gangbusters, but I think you're going to have pretty decent demand in the spring, and
Well,
then we'll see what happens the rest of the year.
what's your take on killing your used turn discipline to kind of stock up to prepare for the spring market? Do you think that's a safe bet coming into the spring given these factors?
Well, it'd be hard to say it's a safe bet. I mean, I don't want to be put in that pigeonholed into that, but we know a lot of people do it, right? And some of the big players do it more, and they may do it more because they've got a balance sheet that allows them to do
That
that.
allows it.
But
Yeah.
if there's vehicles that you sell right, they're your money makers, and you think they're harder to get right now, and you think you're going to sell them in the spring, then it might be worth, like, for the right product for you, whatever your market is, to look at this.
Because every used car manager will clip this quote from interim chief economist
Big
at
time.
Cox saying, "Hey, it's okay for me to hold
Yeah,
something for
yeah.
6 months. I can
That's why I
I
don't
can
want to
kill that
be tied to
temporarily."
it.
No,
So,
I
I'm
know.
just waiting for
We
spring.
we walked you into it. So it's interesting because the trend that you see coming is the one you can prepare for and you can capitalize on. It's
mhm,
the trend that you don't see coming
mhm.
that can bite you or you can benefit from. What's one thing in automotive today that most people may not anticipate that you see hints of in the data out there? Thinking about either December or Q1 26.
Well, yeah, I guess one thing I see that I mean, it's gone to the wayside a little bit, but the EV prices are actually holding in there. And
Interesting.
part of that's mechanical, and I'm talking used EV prices, not new. I think a lot of EV prices were advertised, whether a consumer would get it or not, without that $4,000 tax credit in it. We got through the end of Q3. I do the same thing that I was talking about with the used market, but I do it for used EVs. Monitor the top ones of those. That price bucket has lifted quite a bit from the end of Q3. Now it's starting to go down a little bit over the past couple of weeks, but that's still a pretty affordable product for a consumer if it's the right product for them. And I do talk about this a lot with a lot of people. There are going to be a lot of those cars that come back over the next couple of years. And so if you're a dealer and you say this is not what my vehicle, I don't sell a lot of these, that's going to be a place where you can get inventory actually in the
Hmm.
next couple of years. And so that's kind of my messaging around that. Not trying to advocate either way, right? Being like, look, these are where you can source used vehicles over the next coming years, and we know there's been a lot more consumer adoption for them than there has been for a while. And since the end of the tax incentives, we that narrative is going away a little bit. But I think as we get into Q1, and certainly as we get into the second half of next year, that's going to be a huge story in the marketplace.
Is there if there's a GM out there that wants to protect their front end grosses, and we're hearing a lot about margin compression, inventory
Mhm.
getting better, but margin compression. Is there a data point that GM or dealer should be watching as they seek to protect those front end grosses in December?
Yeah, I mean, I tend to think that a lot of the front end gross scenarios are they're backloaded. Like you've acquired the inventory somehow, some way, and so protecting like December is harder versus where you're going to get into January and February.
Yeah,
And so
because
how are you buying a car?
you make the profit at purchase, right? And if you're doing that now, it's too late.
Yeah, we've cut that data a lot of different ways, and it's got a pretty good 4 to 6 week lag, wholesale to retail. What that is, that's the strongest component. So, being smart, but as we keep moving forward, I believe this. It's December 1st, right? We're
Yep.
we're moving in. Before we know it, it's going to be January 1st. Those people are going to get more money in their take home pay, and as like consumers, if they continue to feel a little bit better, which they've shown recently they are, and the government shutdowns behind us, right? We're going to get more of that data to come back to more people, getting money and seeing is inflation moving the right way, right? Are is unemployment and jobs, how are those things trending? That stuff could matter a lot. Um,
Awesome. Well, Jeremy, Robb, it's been an absolute pleasure hearing your take and perspective on all things economy, automotive, November, December, how you win Q1. Any final takeaways for our audience as they think about the next 30 days, the next 90 days, and winning the day?
No, I think we covered a lot. The consumer is on a little bit of a like a seesaw, teeter totter, if you will, like
Yeah.
where we're going to go from here. I don't know that anybody knows that for sure. It could go negative. I don't want to be negative. I don't, and I think betting against the consumer in the U.S. you've always lost.
Yeah.
So, but at some point they could happen. We just got to see how all that plays out. I think we need a couple more weeks. We'll get some pretty good data points, and we share a lot of this. Whether it's talking here with you through our website, anything like that. We try to bring as much information to help everybody make as good as decisions as they have. So we'll keep trying to do that too.
Awesome. Jeremy Robb, interim chief economist at Cox Automotive. Well, by the way, they need to take away the interim. Just make it official. You'll be
Chief.
the chief economist. You replace Jonathan Smoke. If anyone can do that, Jonathan's a legend in his own right. But Jeremy
He is.
Robb, we appreciate you being on the show. Thank you.
Thank you very much.